Hey, good evening or good afternoon, depending on where you're located right now. Welcome. Thanks for joining us for our Impact Investing webinar on this October 14th. And last time I kind of chatted with everybody in this format, I was live at the Casa Monica Hotel in downtown St. Augustine, and we rolled out the launch of our two new investment funds. Kind of gave a quick overview of them kind of prior to our great keynote speaker. Some of you got a chance to see JJ Bearden, and as to be expected, when you launch two new funds in a single day, we've had lots and lots of interest and questions. And so our team, Larry and Rich and Mike and Bob and team, have been gathering up all the questions. And I'm going to attempt here in the next few minutes, half hour or so here together to answer a lot of the questions that have been coming through on a one-by-one basis to a lot of our team members here, and give some clarity to what we're up to at DLP, why we launched these new funds, how they fit in with our other funds, why all of our funds now are impact investments, and et cetera. So those who weren't with us a couple weeks ago, I'll first recap kind of the overall highlights. I'll start off with our Barry disclaimer, who's our chief legal counsel, little investment disclaimer here. So for those, again, who missed, I'll give you the brief kind of catch up to what I went over a couple weeks ago. That all of our funds at DLP are now impact investment funds, meaning we've mandated the funds to be focused on making a positive impact first on the workforce affordable housing crisis, which is what powers our passion. It's what the focus is here at DLP, is to make an impact on workforce affordable housing, jobs, legacy, and happiness. And we're now self-mandating that we do so in each of our investment vehicles, including the two new funds that we launched on September 30th. Officially, they were launched on October 1st. These are our 9th and our 10th funds that we've launched in the past decade. So it's a pretty big deal when you launch a fund every year or so, launching two in a single day. We now have 5 funds that are active and open to investors here at DLP today, which I'm going to go over with you here over the next few minutes. Each of these funds are now impact investment funds, making a positive impact on providing safe and affordable workforce housing, at the same time providing our investors with above market level returns, as well as creating jobs by helping organizations scale and creating prosperity for all of our investors and those that we invest with, and in the operators that we support. Creating prosperity and avoiding the legacy crisis, or the shirt sleeves to shirt sleeves in 3 generations crisis that probably many of you are quite familiar with, that concept. In addition now to having 5 funds, they all still have some distinct characteristics, such as they're all evergreen, open-ended funds. Now 2 of those funds are evergreen equity funds, meaning they own real estate, and 3 of our funds are lending funds, all targeting above market level returns. Another thing that we rolled out here with our launch of our new funds a couple weeks ago was a feature we call our auto ACH feature. And what we've learned over the years, and what investors have been asking us for, is that people accumulate cash. Those of you who are earning more income than you're spending, whether that be through your job or your business or from your investments, we've seen that capital tend to accrue in your bank account, which we all know essentially earns nothing today. And a lot of investors come to us, they let that cash build up in their bank accounts, and they then come to us and they say, all right, we have 50 grand or we have 100 grand, and they make an investment or an addition with us. But all the while, that cash sat earning nothing. So we've had many investors asking us, because the way that we can get that cash to you on a regular basis so that it's earning these double-digit returns, not sitting. And we weren't ready accounting-wise, because it's a lot of work. It took us some staffing up and some work on our accounting system, so we can now be in the position to roll out an auto ACH feature, which means that on a quarterly basis, you can have it set up that you will add X dollars to your account every quarter, growing your investments with us, getting the incredible power of compounded returns. We can help build a very simple model for you that will allow you to 4X or 5X your initial investment with us in 10 years. Think about that. You invest $250,000, have $1 million to $1.25 million in 10 years through the utilization of this tool. So we're pretty excited about that. We've been working aggressively since we rolled this out a couple weeks ago, getting many investors onto this program, which we can't be more excited about. These little slides here, SB, they might, depending on how big your screen is and how close you are to it, and if you have your glasses on or not, might be a little hard to read, but just gives that illustration, that blue line at the top, the power of just making a little addition to your account on a quarterly basis, how much more capital you have in a 10-year time frame. One of the questions we've been getting is, well, what are the minimums to this program? And can I allocate that amount across multiple different funds? So how we set this up as we initially roll it out is that you can invest $10,000 or more. That'll be automatically added on a quarterly basis. That 10 grand is into any individual fund. You can certainly set up 10 grand into multiple different funds, but 10 grand is the minimum for each individual fund. And then we can always work with you. If you set that 10 grand up or more to go into one specific fund, we can always do a recalibration of your amount in different funds, on an annual basis or something like that to keep your balance where you'd like, depending on what your goals are. So 10 grand minimum per quarter, or in other words, 40 grand a year that you're going to set up automatically to be invested into one of our funds. And again, you can do that across all of our funds, though, which is pretty cool. Another question that we've received a lot is I just gave everybody the quick overview to our impact investment, our impact focus for all of our investments now today is why. Why did we do this? Why would we want to go and self-mandate ourselves to have to make a positive impact on all of our investments? The question that isn't on this slide, but I know some are thinking, maybe don't want to ask, is, well, is this going to then in turn decrease returns? Or, if you're mandating to have to make a positive impact, is that going to have to mean I have to sacrifice in terms of returns? And the short answer to that question is no. It is certainly harder to make sure you're making a positive impact on each investment. But that's what we're already doing. We're just self-mandating that we continue to do that as we grow. So what we've done is in each of our funds, we've mandated at least 85% of our investments have to invest in housing that is affordable and we believe will remain affordable for the local workforce, which means that our rents are less than 30% of the area median income. So really excited about that. We will have some investments from time to time that don't meet that criteria, but at least 85% of our investments are and will continue to be focused on making an impact in this tremendous crisis of affordable workforce housing. In addition, most of our investments are also making an impact on the jobs crisis, happiness crisis, and what we call the legacy crisis. So we expect our returns to continue to be the targets that we laid out, which I'm going to go over and recap here for everybody over the next few minutes together. Next big question we've got with the rollout of our changes is the only one of our existing funds that had any material change to the returns was the Dlp Lending Fund, which has had a 10% preferred return for the past 7 or so years since we launched the fund. And we went and we lowered that preferred return to 8% effective on January 1st of next year. And the reason we did this is pretty straightforward. We want to make sure that we are able to continue to do what we've been doing over the last number of years, which is to go upstream to the best, highest quality borrowers and keep our risk as low as possible in this strategy in order to be able to weather challenges that come up, recessionary environments, things like COVID, by lending to the very best borrowers at low leverage points. So in order to stay very competitive in this zero interest rate environment we're essentially in today, and to be able to continue to track the best borrowers, we have to continue to be able to stay aggressive and also not feel the pressure to need to stretch in order to hit that 10% preferred return each and every month. With that said, our expectation is that we expect to continue to generate north of 10% returns as we have in every month for the past 7+ years. But we're lowering the preferred target to give us flexibility that we're never feeling the pressure to have to get money out, to have to take any undue risk, while still maintaining a target internally of generating over 10% returns, which again, we've done every month. But we want to be in a position. We don't know what turbulence is going to come in the months and years to come. We all know at some point we're going to hit a recessionary environment, which in many ways will benefit us, but will create turbulence. And we want to be in a position to continue to exceed expectations. We're very proud to say and to be a fact that we've never missed return targets in any of our funds. So we want to make sure we're setting conservative expectations and then knocking them out the park. So what we're doing here is sort of resetting conservative expectations so that we can continue to go out and knock it out the park and generate double-digit returns, all distributed to our investors on a monthly basis. While at the same time, we've launched another fund we're going to get into in a moment that'll give you the ability to have a little bit higher returns, still investing in a very similar strategy. Next question here that has been asked quite a few times is, have there been any changes to the subscription and capital call minimums or processes? So this is definitely an important topic here at DLP, and one that we've constantly been working on, creating the right balance in how we deploy capital and what's the minimum amount of capital we take in so we continue to provide the best service as our number of investors continue to grow. We're going to knock it on the door, thanks to so many of you, of 2,000 investors invested with us, 2,000 families that we're servicing. And so what we've decided to do is we have set our subscription minimum at $500,000 per relationship. So that's, a husband and a wife, a family, certain communities that we're a part of. That we have a minimum set across that community or that relationship we have. And we allow you to break that investment up, though, across multiple investments. So you can break that investment up and put some money in the DLP Housing Fund, the Lending Fund, the new Preferred Credit Fund, Building Community Fund. You can break it up accordingly. If you're looking to invest a smaller amount, the DLP Positive Returns Fund has a $100,000 minimum. So $100,000 minimum for Positive Returns Fund, and $500,000 overall relationship size. And then you can allocate that across multiple investments. One of the cool things that this is really the first time that we're saying this to anybody is we have decided that we will keep our minimum at only $250,000 for overall relationship size if you set up the auto ACH option. So that we just talked about. So if you set up and commit that you're going to add a little bit to your account on a quarterly basis, we've lowered our relationship minimum to $250,000 because we want to be able to work with you, grow your relationship with us as we continue to grow and gain your trust and earn additional capital invested from you. So pretty excited about that. You can invest your money with us and send the money in the day you sign your paperwork, or you can do a capital call process. For all investments of $500,000 or more, we'll do a capital call process, meaning you sign the paperwork, you get in line for deployment based on the day you sign your paperwork, and we'll call that capital, meaning we'll let you know when we need the money and give you generally a 2-week notice to wire in or ACH the money into us for deployment. All right, and then any of these questions, I'm answering a lot of questions here. These are the questions that have been asked to us, to our investor success team, by you. But if I didn't address every question here or that leads to another question, type it in. Rich Delgado's here on standby. And after I finish going through these, I'm spending most of today answering questions. We will open up, and depending on how much time we have, continue to take more live questions that come up as we answer the questions you've already asked here over the past couple weeks. All right, so as I said, 2 weeks ago, we launched 2 new investment funds. And for those, again, who missed it or those who were part of it, I'm going to recap them and then answer some of the most common questions specifically on the new investment funds that we just launched. So first up is the Preferred Credit Fund. The Preferred Credit Fund is a preferred real estate credit fund that makes loans backed by real estate, primarily workforce housing. As I said before, 85% of all of our investments will be backed by workforce housing that is and will remain affordable to the local workforce. These are loans that may be in a first position, but they also may be in a subordinate position or second position behind a first position loan. These loans always have significant equity invested behind our loan and have a personal guarantee from the borrower. This fund is going to allow us to continue to build relationships with the very best borrowers and be able to provide the very best borrowers with more flexible capital options to be able to bring value to them, capture their business, and help them invest in this competitive environment. In turn, this fund is going to have the highest preferred return, or has the highest preferred return of any DLP investment fund, of 9% preferred return net to investors before we earn a management fee. And that's the case with all of our funds, that we pay out a preferred return before we even earn a management fee. So the most common question on the preferred credit fund that we've had since we've launched it a couple weeks ago is, given that the preferred credit fund does not only originate first position loans, why do we feel that this fund could potentially be less risky than the Dlp Lending Fund? And it's a phenomenal question. And I'm actually going to walk over to my whiteboard here. And I didn't mention this before, but I am in my headquarters here in St. Augustine, Florida. And this is my office here. And I have wonderful Katie here working the camera. And I'm going to use the whiteboard a little bit here to illustrate a couple things here. And so I'm going to head on over and walk you through a little bit about the preferred credit fund. All right. So the preferred credit fund could be considered lower risk by some investors, depending on how you think about risk, for a couple of specific reasons. So first, I'm going to explain the Dlp Lending Fund, which we've been running for over 7 years now. Has had great success, has generated 10% plus returns to investors every month for 7 years, making first position loans backed by real estate. And in the Dlp Lending Fund, these are rough numbers. These are not exact numbers. And the exact numbers today can be found in our reporting that we provide every month. But rough numbers, the average borrower, and all of our borrowers in both of these funds are the same type of borrower. They're all professional real estate investors. These are not first-time homeowners. These are not loans backed by primary residence. These are investment properties. On average, in the Dlp Lending Fund, there's about $150,000 of equity invested by the borrower. Okay? So on average, the borrower invests $150,000 of equity into that property. That sounds really good. It is really good. Our average loan to cost is 73%. Our borrowers put a lot of skin in the game, as we like to call it. That's pretty important. Other thing that's pretty important is experience. So our average experience of a borrower in the Dlp Lending Fund is they've completed around 50 real estate deals, 50 deals plus or minus. Okay. Another thing that's really important is how much is our borrower worth, especially since our borrowers are providing personal guarantees. Our average borrower is worth about $3.5 million. Okay. So that's their net worth. Okay. So this is the Dlp Lending Fund. Pretty attractive. A lot of money invested behind our loan. They've done 50 plus deals, and they have $3.5 million in personal net worth. Okay. In the Dlp Preferred Credit Fund, across these same criteria, obviously this is a brand new fund, so we don't yet have exact data yet, but our expectation, what we're targeting, is that we're going to have north of $1 million of equity invested in each loan. So 150 grand in lending fund, we expect in the preferred credit fund, it will be over $1 million. It will likely be in multiple $1 million average equity invested behind our loan, meaning that money is subordinate to our interest in the property. We expect the experience is going to be in the hundreds of deals. Many hundreds will be the average borrower, but over 100 for sure. And that the average net worth is going to be north of $10 million. Very likely the net worth will be more like an average of $25 or $30 million. So we're going to be seeing somewhere in the neighborhood of 5 to 10 or even more times the amount of equity invested, multiple times as much experience, and multiple times the net worth of a borrower in the Dlp Lending Fund. This is why we feel, even though not all of these loans are going to be in a first position, these loans will have some very significant factors that reduce risk comparatively to the Dlp Lending Fund, which has never lost money on a single loan, written off $1 of interest on any loan we've originated, now into the thousands of loans. So I'm going to jump back here in front of my computer. All right. So next question here that we've been getting is, what type of loans will be the primary focus of the preferred credit fund? And give us some examples of these types of loans. So the preferred credit fund is going to make loans backed by workforce housing communities, very similar to the Dlp Lending Fund. But again, not all the loans will be in a first position. They will be in a second position, or we like to say a preferred position behind a first position mortgage in some cases. And we have done these types of loans over the years. We have not done them in the Dlp Lending Fund, But this is something we've done a number of times, and we're actually in process right now putting together a couple different case studies that we'll walk you through in future webinars explaining and showing you this. But generally, the borrowers that we do this with, and we've been doing this often, myself, I've been doing this with my own capital, to our very best borrowers. These are the borrowers who are very often in our elite membership. These are the borrowers who come to our events, who are actively helping them scale their business, implement the elite execution system, and in turn, we're willing to get more creative in order to help them capitalize on the opportunities in today's market. All right, so what is the criterion policy for us to decide if we're going to put a loan in the preferred credit fund or into the Dlp Lending Fund? So in general, if the loan meets the Dlp Lending Fund's criteria, the loan will be made from the Dlp Lending Fund. Generally, the loans that go into the preferred credit fund will be loans that don't meet the lending fund's criteria, either because we're higher on LTC or LTV than we would normally do with the lending fund, or because the loan is a subordinate loan behind a first position loan. Generally the case, they're going to be loans that aren't fitting the box of the Dlp Lending Fund. It doesn't mean necessarily it's a bad thing or it's more risk, but it doesn't meet the semi-narrow box that we've set for the Dlp Lending Fund in terms of the structure of the loan itself. Another common question we're getting is, will the DLP Capital put a second position loan in the preferred credit fund that would sit behind the Dlp Lending Fund? And if so, when would we be willing to do this? And the short answer is yes, absolutely. We expect a decent percentage, and we don't know what that percentage yet will be because this is a new fund for us, but we do expect a good percentage of the loans we originate will be a second position loan behind the Dlp Lending Fund, which is honestly an ideal situation because then we as a lender control, both loans. We control and mitigate any risk of any other lenders involved in the equation. So yes, we do expect that very likely a majority of the loans, we will have both the first and the second loan, one in the Dlp Lending Fund and the second in the Preferred Credit Fund. All right, so that's the Preferred Credit Fund. I'm going to move to our second new fund that we launched here in the last couple weeks, the Dlp Building Communities Fund. So this is a real estate equity fund similar to the Dlp Housing Fund in that it directly owns the real estate. Most of the real estate that we own are going to be rental communities, multifamily communities, in addition to single family rental communities, but the majority being multifamily. The difference here between the Dlp Housing Fund and the Dlp Building Communities Fund is that in this fund, as the name alludes to, we are building communities, meaning these are ground up new communities, not existing communities already existing and already generating cash flow. So these are brand new rental communities that we're building. We're able to still provide all the same tax shelters and benefits of the Dlp Housing Fund or of owning real estate. But again, we're building brand new communities that we believe and have proven that we can build to a better yield, or in other words, generate a better return than buying existing communities while making an absolutely tremendous impact on the workforce housing crisis. The only way we slow down the incredible growth of rents in America and stop the dramatic pace at which the affordable crisis is growing is through creation of more housing. We simply have an undersupply of housing throughout most of the United States. Here are some of the highlights to the Dlp Building Communities Fund. It has a preferred return of 8%. That preferred return is paid before we earn anything. As an annualized return target, this is the highest return of any Dlp fund of 13% net to investors. That management fee of 1.5% is subordinate to the preferred return. This is a $250 million fund with annual distributions and annual liquidity. One of the things I just realized I skipped over when I talked about the Preferred Credit Fund, that fund has a 90-day liquidity just like the Dlp Lending Fund. All right, so question here. Is the focus on ground-up construction development a new investment type for Dlp Capital? Essentially, I guess, if not, what experience and expertise do we have in this asset class? What type of track record do we have? So I'm going to walk you through one deal, and I'll answer the question as I kind of walk through this deal. So this is our most recent ground-up deal that we built. This is 200 units. They are 3- and 4-story multifamily units, as well as townhomes and cottages. This is in Wind Gap, Pennsylvania. This is about 15 minutes from our Bethlehem, Pennsylvania headquarters. This is a community that we finished construction just about 2 months ago. We are nearly 100% occupied. Our rents, which is good from an investment standpoint, are 21% higher than what we targeted when we underwrote the property. We have some great local employers there. We leased this property up as fast as construction got done. The units were leased. We didn't have to give out any rent concessions or reductions. In this area, the average income of a family in this area is $80,000, which is pretty good. But for the average family earning $80,000, finding a place to live that they can afford is still very challenging, as there is a major undersupply of rental housing. So even though this is brand new, beautiful, nice housing, it's still very much affordable and in incredible demand for the local residents in this area. You can see that top picture is when we bought the property, what it looked like. And actually, we had worked out with the developer who started putting some of that infrastructure in prior to closing. And then you see what it looks like now today in the bottom. Here's some more pictures of the top middle picture is the clubhouse. The bottom left are the townhomes. You see the signage in the top left, and then some of the interior pictures. So we have built communities of ground up townhome communities, like those attached townhomes there. We built entire communities like that. We have built 3- and 4-story multifamily communities. We have built detached single-family rental communities. So we've had a lot of experience at DLP in building ground-up housing over the years. Most of those investments that we have done in ground-up construction, I've made those investments outside of the fund because we wanted to build our track record, our experience, our knowledge base, and our team, and kind of take the risk ourselves prior to bringing in other capital. Now we've successfully done that over the last 7 or 8 years. In addition to that, we've built a very, very experienced team. We've brought in SVPs of development and construction with deep backgrounds in ground-up development and construction. Support staff accordingly built out our investment team with experience in development. And then the other unique thing is that through our network of our elite membership, the borrowers, the operators we work with, a lot of our investments are structured where we're actually partnering and providing preferred equity with other very experienced developers. Developers who built tens of thousands of ground-up units. We're coming in and partnering with them and supporting them and investing typically in an insulated manner where their money is invested behind ours, protecting our investors and our funds even more. All right, so some of the questions here on the Building Community Fund. Given that you are taking in commitments into the community fund, do you have an active pipeline, and what will expected deployment be in this fund? So yes, we do have a pipeline. We are under contract and finalizing contracts on over 2,000 ground-up units right now. And we have a number of projects already in development, already in construction. For full transparency, we're actually evaluating right now if any of the projects already in development and construction will make sense to move into the fund. And part of what's going to dictate that is how much capital comes into the fund, how fast. So we make sure that we can deploy capital quickly. So in terms of capital deployment timeframe, I can't give you an exact date, but I do expect the initial commitments that are coming in now, and quite a bit of capital has been coming in here over the last couple weeks that we will be able to deploy capital coming in here right now. It's been coming in the first few weeks here over the next 60 to 90 days. And with the pipeline that we've been building here, we expect to be able to deploy capital in this fund as fast as anywhere else here at DLP very, very quickly. All right, so questions. When people hear about construction development, if you pay any attention to what's going on in the news, especially over the past year, people generally have questions around, well, what about all the stuff I'm hearing about the news? What about the incredible increase in costs of materials? What about the increase in costs of land? You know, how does this weigh into your ability to create good returns? And how could it be possible that you could generate better returns essentially in ground up versus value add, or building new versus buying existing? So yes, building material costs have gone up. Labor has gone up. Supply chain has slowed down in many cases. And in general, land has gone up in cost. With all that said, fortunately for us all as investors, sort of unfortunately for the average renter, rents have drastically gone up at a pace that has outpaced the increase in cost of construction. In addition, the demand to own workforce housing or rental housing existing assets today has never ever been higher. There's never been more capital that wants to invest in existing multifamily communities than there is today. That the cap rates and the yields have gone down so much that often today the average 1970s or 1980s built apartment community are being purchased often in the 3 and 4 cap rate basis. Every deal that we're building at DLP or in development on we're north of a 6 cap rate, often north of 7 cap rates on what we're building ground up. So as crazy as it sounds, we can build a brand new 2021, 2022 apartment community at a better return, often a significantly better return than you can buy a 40-year-old apartment community. And that's what's so attractive about this from an investment standpoint. What's so attractive about it from an overall standpoint is this is what America needs is more housing. This is the way that we're going to keep housing, not just for rent, but for sale housing as well, to keep from growing at these double-digit 15, 20% annual clip that we've seen this past year is we need to build more housing. All right, so next question. What impact do current supply chain issues have? So I kind of touched on it already. We've dealt with a lot of supply chain issues through COVID. Good news, a lot of those are loosening up. But this is one of the great values in investing with somebody such as DLP versus trying to go do this on your own is due to our size, our scope, our vendor relationships. We've been able to be prioritized, be able to still get materials. Not saying it's always easy, but it hasn't slowed us down to any significant levels, plus good planning. So planning out ahead, getting your orders in earlier, making sure through good logistics planning that you can keep moving forward. So certainly been challenging, some things more than others, but the good news is things are loosening up, but we've been able to continue to get product, continue to get labor, and not have had any significant delays to date, which is exciting. And tell you those on our construction team will tell you in more depth than I just kind of skimmed over how difficult certainly this issue has been. But they've done a phenomenal job of working through it and continuing to not be slowed down and being able to get units completed. That's both on the renovation side and on the new construction side over the past couple years. All right, so question is, how will fair market value be determined and when will annual distributions be made? So just like the DLP Housing Fund, we go through and we update the value of all of our assets every year. We get typically independent third-party appraisers to go and appraise the value of each of our assets. And then we distribute out the unrealized and the realized gains in March to April of each year. So in short, we'll pay out the annual distributions March to April of the following year. The fair market values are completed at the end of each year. And that increase in value as well as the actual cash we've generated through the income we earn as the properties start being leased, as well as from the sale of communities as we sell communities as they get completed, will together create the 13% plus return target and allow us to pay out the 8% preferred distribution on an annual basis. So I believe I basically just answered this question here through that last answer. So yes, we will be paying out an 8% preferred distribution from income as we start leasing the properties up, from the sale of the communities, and from the unrealized gain of us developing and building communities at a cost lower than the community is worth, in short. And that's what's going to help us to be able to generate north of 13% returns net to investors. So once we complete these properties and we lease them up, what will we be doing with these properties? Will we keep the properties in the Building Communities Fund, sell them into the Housing Fund, or look to sell them in the market? So the short answer is the great thing is we can do all of the above. So there's nothing that precludes us, if it made sense for us to do so, to keep the properties in the DLP Building Communities Fund. We can sell those properties into the DLP Housing Fund, which is designed to own income-producing leased-up properties, or we could sell them through the market if the market's so hot that it made better sense to sell the properties. We have flexibility to do any of the above. The reality is there'll probably be some combination of all of the above. It's not part of our business plan to keep properties in the fund long-term once they're leased up. But if we were in a recessionary environment and didn't make sense to sell a property at that point in time, we may choose to do so for a period of time. We have that flexibility to do so, and we've modeled it out in each of these scenarios to be able to generate our 13% plus net returns to investors. All right, so those are the questions on the Building Community Fund. I got a few last questions, I think, here that are more sort of general questions and some questions about how this kind of all works together. Question we've been getting a good amount, considering the Dlp Lending Fund and the Dlp Housing Fund are both private REITs. Question of why didn't we set up these funds as private REITs, the Building Community Fund and the Preferred Credit Fund? The short answer to this question is because it didn't make sense due to the rules of REITs to be able to do so. So as an example, you can't be a developer in a REIT, meaning when you have to own assets in a REIT. If it's an equity REIT, such as the Dlp Housing Fund, for at least 2 years. You can't build and sell an asset in less than 2 years. They're actually not allowed to be a developer. You have to be a long-term owner of housing to have a REIT status. On the lending side, all of the loans have to be first position mortgages, in short, to be categorized as a REIT. So there's some very specific rules to be able to be a REIT that if you don't follow those guidelines to a T, all of your income can actually be taxed. Not taxable, but taxed. So very specific rules. So for those limitations of those rules create, neither of these funds made sense to be REITs. And the REIT status is really simply a tax election. But to get that tax election, which provides you with unlimited qualified business income, you have to follow very specific rules that neither of these funds are able to do or could do, but it would limit our functionality and the returns that we'd be able to generate. So it didn't make sense to be private REITs. All right, so can you explain the difference of the funds and why someone would choose one fund or the other? And I'm going to go back to the whiteboard here for this one, and I'm going to walk us through a little visualization. And as I walk us through that visualization, I'm going to skip ahead here and show this slide. So you'll be able to see kind of a little comparison while I walk through this and walk through my opinion to why you would choose one or the other. Let me do a quick erase here. So on the slide, if you're looking at the PowerPoint, you'll see a little overview that walks you through a lot of the comparisons of one fund over the other. And there's actually a second page to this, and we'll happily, after this webinar, send anybody the full overview of every category of each of the different funds and how each fund stacks up. So you can really simply look at, all right, what does this fund do? How does it compare to the others? Which fund generates the highest return? Which fund is best from a tax standpoint, et cetera. But I'm going to walk you through what I think are the less than even a handful of reasons that you would choose one fund over the other. So I'm going to start first with returns. Then I'm going to talk about liquidity, taxes, and cash flow. I think at the end of the day, these are the categories of why you would choose one fund over the other. So I'm going to first start from oldest fund to newest, the lending fund, the housing fund. I'm going to skip the positive note fund, which is a fixed return only fund paying 3 to 7.5% fixed return. So you would choose that fund to get a fixed return guaranteed by DLP, not guaranteed by the FDIC, lower minimum return, fixed guaranteed returns. So that one's slightly different, but I'm going to compare the 4 equity funds with one another here and give you the overview of why you would choose one or the other. All right, so we got the lending fund, the housing fund, the preferred credit fund, and the building communities fund. So first is returns, right? The first thing you think about in making investment. What is my return going to be? Okay. So the first, if you were thinking in your number one criteria to you in what investment you make is return, then your number one best place to go is the building communities fund. That's the best fund in that it has the highest returns. So this fund has a 13% return target. You would choose that fund for the highest returns. The second best option is the DLP Housing Fund, which has a 10 to 12% annual return target. The third best option would be the Preferred Credit Fund, which has a 10% return target. And the fourth would be the Lending Fund, which has a 9% return target, but has never generated returns less than 10+%. So from a practical standpoint, we expect to generate double-digit returns in all of these funds. But if highest return was your number one criteria, you would choose the Building Communities Fund. Now, other thing I'll mention before I go to the next item here is many investors here with DLP, they invest in multiple funds and they diversify their investments, and they will choose based on a number of factors, including if their money is qualified or non-qualified, which fund makes the best sense, which we'll talk about. We'll tie into the tax conversation in a minute. So it's not that you have to make one decision or another. You can diversify amongst them. But depending on your goal, you say, look, my biggest goal and what I do with DLP is highest returns. Building Community Fund is going to be the best option for you. Next, let's talk about liquidity. So if liquidity, getting access to your money, being able to redeem your investment quickly is your number one goal, then your option is actually a tie. There's two options here that would both be a number one. So you call them 1A and 1B here, would be the Preferred Credit Fund and the Lending Fund. They both have 90-day liquidity, meaning you can come, there's no tie-up period, meaning you don't have to wait a year or any certain amount of time. You can invest today and tomorrow give us notice, and we will redeem your investment within 90 days. From a practical standpoint, we've always been able to provide liquidity much faster even than 90 days, but they're set up to provide 90-day liquidity. So those funds both provide you with 90-day liquidity. The Housing Fund and the Building Community Funds I'll call 3A and 3B because they both have the same annual liquidity. So very, very much the same. You can redeem out in a 60-day window, beginning of each year. You can request redemption, and we redeem you out over the next 120 to 180 days. So compared to most real estate investments, all of our options are very liquid because you're not stuck in an investment for 5 years or 7 years or 10 years or indefinitely. You have clear liquidity options in all of our funds. All right, the third option is taxes. If your biggest focus is minimizing taxes, your number one option, you're going to also have a 1A and a 1B here, but kind of the reverse this time. The Building Community Fund and the Housing Fund are both structured to be able to defer all of the income we're distributing out on an annual basis from tax through depreciation predominantly. So both funds are very, very, very tax efficient. Depends on a number of factors. One could end up being slightly more tax efficient one year from the next, but both funds are very, very tax efficient, provide all the benefits of owning real estate and utilizing leverage and owning real estate. So those are 1A and 1B. Lending Fund, I'll call, I guess you call it 3 actually. So they have a 1A and 1B, and then I'll call the Preferred Credit Fund 4. They are both very, very similar. The only difference is the Lending Fund, because it is a REIT, it has unlimited qualified business income deduction versus the Preferred Credit Fund. There is a limit on how much qualified business income deduction you can have, and I'll explain that. So for most people, this doesn't matter because the number, I believe, is around $4 million in income. So for most people, you're not going to run up against the limit anyway. But what the qualified business income deduction is, and all of our funds have this, is that you get a 20% reduction in the tax bracket you pay for your ordinary income. So all of our funds have this 20% tax reduction in today's tax code. So they're both very, very similar, but Lending Fund has no limit. So it's slightly more tax efficient. And then lastly is cash flow. So getting consistent cash flow, if earning income off your investments with DLP is your biggest priority, then you're going to have the DLP Lending Fund as 1A and the Preferred Credit Fund as 1B, as they both distribute their cash flow out with high preferred returns, distributing the cash flow out on a monthly basis. Second would be the DLP Housing Fund, or actually third then, since I call this 1A and 1B. Third would be the Housing Fund, which gives you the option of a 6% preferred return paid out every month. And then last, you certainly would not choose the Building Communities Fund if cash flow was your biggest driver, because our cash flow is only distributed on an annual basis in the Building Communities Fund. So based on your goals with your investment, it's going to dictate which of these funds make the best sense. So again, to recap, if you want the highest returns, you're going to go to the Building Communities Fund. If you want the best liquidity, you're going to go to the Lending Fund or the Preferred Credit Fund. If you want the most tax efficient fund, you can't go wrong with the Housing Fund or the Building Communities Fund. And then if you want great consistent monthly cash flow, you can't go wrong with any of the three funds of the Housing Fund, Lending Fund, or Preferred Credit Fund, but the Lending Fund and Preferred Credit provide the best cash flow on a monthly basis. So this is an overview of why you would decide. Of course, there's other smaller factors that could be worth consideration, but these are the big factors that we find at the end of the day most investors make their decisions about. And the last comment on this I'll include kind of this with is if you're investing with qualified funds, meaning these are not just cash, it's in an IRA, an old 401k, some sort of qualified account, it changes the formula a little bit in that now the Dlp Lending Fund and the Dlp Preferred Credit Fund don't have the factor of being less tax efficient because you're sheltering the income from tax. So what a lot of investors do with us if they have both qualified and non-qualified funds is they invest their qualified money in the Lending Fund or the Preferred Credit Fund, and they invest their non-qualified money in the Housing Fund and now the Building Communities Fund. So we're happy to work with you, help do that analysis with you, help determine which fund makes the best sense. If you're already in, say, the Lending Fund, we're happy to work with you and determine does it make sense to move any of that capital into one of our other funds for tax reasons, income reasons, liquidity reasons, etc. So that's the overview of how our funds work. We'll send out this overview that gives you all the categories, but these are the high level why you would choose one fund over another. All right, so with that said, that may be our last slide. I think it is. Actually, no, we have a couple more on some upcoming events I don't want to miss out on. It looks like we're not going to have time for many questions here, but maybe we can take a couple, Rich. So last couple things before we get to questions, I want to let everybody know a couple big news items, actually. So first, I want to make sure everybody hears is in November here, we were scheduled to have a big event in Ponte Vedra Beach, just a few miles up the road from where I'm talking to you from right now on November 11th to the 13th. Unfortunately, we had some issues with the venue that we had too many people for the space that we had booked. We were going to have people sitting in separate rooms for dinners and so forth. It just didn't work. So we made a big decision yesterday and made a pivot here. So the November event is going to be our first ever virtual full prosperity event. It's going to kick off Thursday evening, go all the way through Saturday afternoon. We're still going to have tremendous speakers on with us virtually. We're going to be sending out some cool gift packages to make it feel like a live event for everybody. We're going to still do workshop activities together. If you've been to one of our events, it's going to be much of the same, but you get to do it from the comfort of your own home. Really excited about that because we know it means we're going to be able to have a lot more people join us as a prosperity member or investor as listening here today. There's no cost to joining us. So go ahead, there's the link. We'll drop it into the chat for you too, but you can go to our website /November virtual, or you can just go to DLP Capital /events and you can find it there. Go ahead and get yourself registered. If you already registered for the live event, we'll be following up with you and confirm you still want to join us virtually. And then what we're going to do is we booked some bigger space essentially at the Sawgrass in Ponte Vedra Beach for March 17th to the 20th. So we'll be doing a big live event in March here in Ponte Vedra, but in November we'll be doing the event virtually. So please go get signed up to join us virtually, and then get signed up to come spend some time with us March towards the end, depending on where you live, towards the end of the winter when it's freezing cold. Coming to March, we're in Ponte Vedra, where it's likely to be in the 70s and sunny. Great place to be. Hoping you can come join us there live. And then, of course, to talk to any of us about anything I went over here today or otherwise, including getting set up for these events, you can always reach out to any of the handsome gentlemen here on the slide here, whoever you're working with. If you're not working with anybody yet, pick the most handsome there. You got great choices, and we'd love to help you out. And then before I open it up to Rich to allow us to hit a couple questions here, I want to invite kind of a special invite here. Tomorrow is Living Fully Day here at DLP. And you can see I got my Living Fully shirt here I'll be wearing tomorrow. But this is a big day we do at DLP each year where we kind of do everything but focus on DLP for the day. And we focus on helping all of our team members live fully across the 8 F's of life: faith, family, friends, freedom, fun, fulfillment, fitness, and finance. We've got a lot of cool speakers coming in on things like stress management and fitness and so forth. So we're going to all be doing it live here at DLP, but we're giving the option for family members of our team members, as well as for our investors, to join us virtually and be a part of the day with us and our team members. So if that grabs your attention, something you'd like to be a part of, you can go there to dlpcapital.com/LFD, stands for Living Fully Day, LFD, and join us for part or all of the day. We welcome you, love you to be a part of Living Fully Day with us. All right, Rich, I'm going to open it up to you for time for a couple questions here before we adjourn.
All right, excellent. Well, appreciate it. Thank you, everyone. So I'm going to start with Manish, which is, this is a question that's on everyone's mind on the potential tax law changes, and there's a lot to unpack there, so we'll just keep it simple. The potential for the restriction on IRA investments, any thoughts and potential impacts on our funds?
Yeah, it's a big question. For anybody who doesn't know, there's conversations about IRAs being limited of investing in basically in private investment opportunities, such as DLP's funds. First thing I'll say is and I obviously very much hope I'm right, is I do not think it's going to go through. We're involved at DLP. A number of our leaders are involved with a few organizations right now that are fighting against this and working with the lawmakers and fighting against this change. To me, I understand the reasoning for it, but it doesn't make sense. So fortunately, there's a lot of great support against this potential change. I do not think it will go through. Certainly hoping for all of you and for us that it doesn't. So we'll keep everybody abreast as we find out more information. This is relatively new, but we're all over it here at DLP, working aggressively to combat that change for the benefit of all of us.
Excellent. Thank you again. Going then with a question that we didn't talk about is the Income and Growth Fund. We have some investors that want to know, is it being phased out, or how should an investor think about how this is being treated in the context of the 5 funds that are still available?
Yeah, great question. For anybody who's new, you don't know what we're talking about, but for those of you who invested in the Income and Growth Fund, it's a fund we've had since 2016. It's another lending credit fund. And so the fund is still in operations, meaning we're still running the fund. The fund's still making investments. We're just not taking any new capital into the fund. We do not have any scheduled wind down of the Income and Growth Fund. Eventually, it may wind down, but we don't have any plan for that. Very likely the fund will be running in multiple years from now. So for those in the fund already, there's no urgency to exit the fund. You're certainly, if one of the other funds was more of interest to you, we just launched, we certainly had that conversation with you, but no urgency. You continue to be in the fund, and we expect the fund to continue to perform as it has. I know I just saw the financials for Q3 yesterday, and they were great. So funds continue to do really well and expected to continue to do for many quarters ahead.
Fantastic. Thank you. So another couple of questions on the Building Communities Fund. First is, will the fund take advantage of any qualified opportunity zones?
Yeah. So yes, and sort of no, I guess. So to not to get too deep into the weeds at a time, opportunity zones are quite interesting. Incentive that was created that can create some unique benefits to investors to be able to avoid paying large gains on investments you've made, such as in Apple stock or Amazon stock as an example. The way we underwrite deals is the deal has to work regardless of being an opportunity zone. It has to be standalone, make great sense. Then if it happens to be an opportunity zone, it's sort of a tremendous benefit. In order to get the benefits, though, of it being an opportunity zone for you as an investor, the fund has to be an opportunity zone investment. So if we come across a great opportunity zone ground up deal, what we would probably do is create a opportunity zone fund that would be in part potentially owned by the DLP Building Communities Fund or roll up to the fund, but we need to create a little bit different vehicle that you can invest in to get those tax benefits. So I think probably the more specific answer is there is certainly possible that we could have a opportunity zone investment opportunity for investors. We don't have anything in process right now, but that's certainly possible. And happily over ask that question, we can dig deeper and explain that further if there's more specific questions, but that's the semi-high level answer.
Perfect, thank you. And then again, on the Building Communities Fund, how can we assure if a property is developed and then sold away from the Communities Fund, will it continue to be affordable with the new owner?
Yeah, that's a really good question. So the short answer is no, we can't guarantee that. But I'd say fundamentally, when we invest in a community, especially when we're building something, we're designing it, we're first starting off with fundamentally finding opportunities, finding geographic locations where there's demand and where you can build communities where we can be affordable for that local workforce. So starting point is we're fundamentally making the right investment decisions that allow us to be able to do this, which it's not easy to do with where the cost is today to build and where affordability lies. So the property I showed, Dream Lehigh Valley, is a perfect example of that, where we're able to build a ground up community because the incomes are a little bit higher there. That doesn't mean, if anybody who knows, $80,000 family income for two working adults, right, is not, these aren't wealthy people, right? These are two hardworking people earning, often $40,000 this year. These are your teachers, these are your social workers, et cetera. And that demand and the need for an affordable place to live, they can afford and still pay for education for their kids, and both have a car and afford, food and be able to eat out once in a while and so forth is not an easy thing to come by in many markets. So structurally, we're making investments that focus on that. But no, we can't guarantee the next guy who buys it isn't going to go and jack up rents and drive more, luxury amenities and drive up rents. It's not something we can guarantee. But we think through doing things like making it clear that DLP is an impact investor, focusing and calling all of the borrowers and operators that we lend to and we invest in to focus on making an impact of keeping housing affordable, doing things like this. We think we're on the beginning of a movement of making this more common, that people are going to want to be a part of keeping housing affordable, and understanding that doesn't mean you're sacrificing returns. It's just a different strategy. It's about keeping residents apart, helping them live in a place they feel they're part of a community, not just a place to live, a place where they want to stay. So they're not moving every 14 to 16 months, which is typical in apartments, and paying for moving, paying for more security deposits, paying for all the expenses of moving constantly. And in turn, as an owner, we cut down our turnover costs. We cut down our maintenance costs. We cut down a lot of expenses by making it a place that people want to stay. And that allows us to have a different business model than that of a lot of apartment owners today.
Excellent. Thank you very much. Since we are almost out of time, we've got 1 minute, 2 quick rapid fire questions. One is, do investors need to file state returns for each state since our funds have properties in multiple states?
No.
Short answer, love it. Right. And then the next is, which funds are domiciled in PA and subject to PA taxes? And are you considering incorporating in tax-friendly states like Florida?
Great question.
Income and growth is Pennsylvania.
Yeah, I was going to say, I know so the Income and Growth Fund is the only one, I believe, that's still in Pennsylvania. And that is one of the reasons to why we launched the Preferred Credit Fund as an example, versus just continuing to grow the Income and Growth Fund, was to be able to domicile in Florida and avoid that state income tax. So I don't know exactly. I know Barry and our legal team are still working to see if there's a way that we can move to a state without state income tax. I don't think as of last update I received, we haven't figured out a solution that wouldn't create a risk of later of significant tax in doing so. So that is one of the reasons, significant reasons, to why we're not continuing to grow the Income Growth Fund, because of the Pennsylvania state structure.
Excellent. So that's our time. It's 5 o'clock. We'll let you wrap up, but look forward to seeing everyone on Living Fully Day tomorrow. And then more importantly, seeing you in November virtually for our prosperity event. So wrap us up, Don.
All right. Thank you, Rich. Thanks, everybody. Appreciate all your time here with me. Thanks for all the questions everybody's been sending in. I hope we gave some clarity here today, and look forward to continuing to having the opportunity to serve you. And as Rich said, look forward to seeing you at our upcoming events. Thanks, everybody.
Have a blessed week, everyone.